Now we're moving on to the scenario building, slightly more practical element of the course. The aim of this module is to prepare you for any central bank meeting. It's not one specific one, it's any central bank. And what I'm aiming to do is give you a clear framework to do this. This way, you have a process to move through the information that you've gained at the previous meeting, since the previous meeting, and what this is going to tell you about trade opportunities at the coming up meeting. So let's move on. We'll start off with the first element of your central bank preparation. Okay, so first up, what happened at the previous meeting? Throughout this module, I'm going to use the example of the ECB in December 2016. We're going to look at the preamble to this and how this created a trade, how this developed various scenarios and potential opportunities in the market, and then also how you actually execute that trade. So any references will be towards that meeting. So what happened in the previous meeting? You need to break this down, and you're breaking it down into three areas. First up, policy change. Did anything change at the previous meeting? Central banks recently have been a little bit reticent to change and then change once again. So if we've seen a change at a previous meeting, potentially that means we've got less likelihood of a change at this forthcoming one. So first up, policy change. Next, any guidance to future action. Central banks try and communicate very transparently how they're going to move going forward. What they don't want is to shock the markets. They don't want suddenly to change interest rate policy or change their asset purchases, and this be a major shock to markets, as we've seen for example that surprise interest rate cut from the Federal Reserve. You could see 5% moves in market very easily, and this is not something that the central bank wants to do. They don't want to create volatility. So the aim is that they will guide the market either by references to certain changes in data point, that's known as a central bank being data dependent, or they will use certain taglines. You'll notice as you read through various different central bank statements that they use specific taglines to indicate something coming forward. I'll give you a very clear example. The ECB many years ago, I say many years ago, 2008, 9, 10, had a very clear strategy for signalling moves in forthcoming meetings. Jean-Claude Trichet, the head of the ECB at the time, would use the phrase vigilance or strong vigilance. If he said something along the lines of the ECB will be strongly vigilant regarding monetary policy going forward, then that signalled very clearly that the next meeting there would be a rate hike. So this use of strong vigilance signalled forward what was going to happen. The idea there was that the markets weren't suddenly shocked if the ECB suddenly raised rates. However, what this then served to do was create a larger impact on the meeting when he used the phrase strong vigilance than it did when they actually changed rates. So effectively they were just front loading the move, but ultimately hoping that by the time the rates change, market would have equalised itself back out. And finally, you want to be having a look at the market reaction. Whilst the headlines may say something that's quite big or apparently quite big, seems very important, market reaction may be very muted to this. So you've got to be looking at in terms of, was the market satisfied with the results? If, say, for example, a central bank, and this a great example of this is if you have a look at the ECB in 2015, this is where I want you to do your own research as well. Go and have a look at what happened in the ECB in 2015, December. The ECB had signalled that they may well increase or at least increase the stimulus in some way. This was viewed by the market as likely to be an increase in QE, so more bond buying. What happened is they merely extended the duration of bond buys. The market was very dissatisfied with this, and rather than seeing equity markets, for example, rising, bond markets rising, we actually saw very, very hard sell-offs in equity markets and bond markets for that matter. I'll give you an example. The DAX fell around about 500 ticks on the day, which is a very big move. DAX does have big ranges, but 120 ticks is probably quite a big range. 500 is exceptional. What you've also got to look at, and we'll look at this as we go through what's changed, is also, has anything been priced into the market? So has any new interest rate been priced in? Has any new QE been priced in? So that's what you need to be looking at as well. And the market move will tell you this. And I'll explain to you how you can perceive this pricing in a few slides time. And you'll be able to understand that to a little bit of a greater detail. So moving on. What happened in the last meeting? Let's have a look. So the previous meeting in October 2016. This is the statement from the ECB. You can get all of these statements on their website, and I'll leave a link for you to go and do that and have a read through some of these statements. What you'll notice is a distinct pattern in the way that the statements are constructed, certain words that are used, certain lines and phrases. And we'll come on to this a little bit more when we actually do the individual central bank drills with specific trades relating to certain elements of central bank policy. So in 2016, I've highlighted the key things. ECB left key interest rates unchanged. That was expected. They also stated that their bond buying of 80 billion a month was intended to run until March 2017. That equally was reiterating information we already knew. So nothing new there. However, what the ECB did do, and this is the forward guidance tagline idea, they guided the market. They said in December, the Governing Council's assessment will benefit from new staff economic projections. And they are going to be looking at options to ensure smooth implementation of our purchase programme until March 2017. Now, in the past, and this is where reading through previous statements helps, whenever the ECB signals that they could be talking about asset purchases or stimulus at the next meeting, often signals that there's likely to be a change at that meeting. So the wheels have been set in motion there. Markets got to start thinking about what could happen at the next meeting. So that's the situation in terms of statement. In terms of how the market reacted to it, let's have a look. What I've got for you here is on the left, the Bund, the Euro, and then the DAX. So you've got a bond market, currency market, and an equity market. Now, when the phrase about assessing in December came up, that's where you saw the strong moves. That's where you saw that straight line sell-off in the Bund. It's where you saw it in the DAX as well. Both because the perception is that stimulus may well be drawn back in December. To what degree, no one knows. But think about it from a pricing point of view. If you're in a position, if say you're long DAX, so you're long equity markets, and all of a sudden you're told that come March next year, potentially there will be less buying by the central bank. This therefore means less demand in the economy, likely lower share prices. Therefore, would it be advisable now to reduce some of your holdings of equities? Likewise, that reduction in stimulus is going to create a rise in interest rates, and that's what caused the Bund to sell off. So the initial reaction has shown you what the market really thinks of this. Very fast moves are. Yes, they have been reversed throughout the day. I think that's also a flip side of the market thinking to themselves, well, if stimulus is being pared back, this is surely a good thing, in terms of that showing that the economy is growing, showing that the economy is improving. So good news longer term, but initially the market is not keen on this potential reduction in stimulus. So we've seen what's happened at the previous meeting. It's now a case of looking for the expectations and pricing. So we'll come on to pricing in a moment. Expectation wise, what you've got to be thinking about is, what's the market really expecting to come out of this? Because there's any deviation from those expectations, that's where the trade is. That's where the interesting part of the day is. So first area to look at, you're going to be looking at economists' expectations. Now these will be published. They'll come from a survey of multiple economists. These are economists from banks, hedge funds, various financial companies. You will then get a general consensus of whether they expect a rate increase, a rate decrease, unchanged. Same with any other empirical data, so quantitative easing, monthly purchase amount or duration of those purchases. So anything that can be quantified, you'll see in the analysts' expectations, economists' expectations. So that begins to guide you in what you want to be looking for and understanding something that is going to be out of line. Next up, general news articles, research. This is the kind of thing that you need to read through yourself. Most large financial publications and media outlets will produce some kind of preamble. So you usually get something from the Financial Times, Wall Street Journal, CNBC and Bloomberg TV. Not only will do a piece on their TV shows, but also on their websites as well. So read through these. It might pick up on something that's been going on in the market that you've not noticed, or in a market that you've perhaps not been looking at. But also, it will give you a sense of areas that are going to be focused on. And that's often the case, that if a market is very focused on a certain area, that's where the interest goes. That's where the trading happens. May not be the most important thing, but if it's the most media hype thing and the thing that everyone's focusing on, that's where the market's going to start trading. And that's going to be the area of movement that is likely to create some of the biggest moves. So make sure you read in all your news research. It also expands your ideas on other things that could happen that perhaps you've not really thought about, or perhaps not discussed with the rest of your trading floor. Next up is pricing. Now, there's one thing to have an expectation, and that's your economist's expectation. They believe X is going to happen. Market pricing is very important, because if the pricing doesn't match the expectation, then the market's going to have to shift in order to meet that expectation, or the market is setting up a sense that it could have an extended move one way or another, because perhaps it's pricing in something that is less likely to happen. So you can look at it from a general point of view in terms of how certain markets have moved in the period between the previous meeting and the meeting that you're about to get to. You can also look at distinct pricing, and this is mostly for rates. And you can see this from the OIS, overnight index swap rates. What you're looking for is the movement from the close up until the current meeting that we're about to have. Now, from the previous meeting to the current meeting. The idea is that the distance this has moved is showing the pricing of a rate hike. And I'll show you how you can visualize that by looking at short-term interest rate markets, which show you what the expectation is of a rate hike at certain points in time going forward. And that's what's meant by looking along the curve. So the curve of interest rates going forward, you're looking along the curve for where interest rates are expected to rise. So if, for example, the expectation is that interest rates are going to rise next December, and actually the curve pricing is saying that they're going to rise the following June, if the central bank signals that they could raise next December, then that pricing is going to have to be moved forward. Therefore, you will see a sell-off in the shorter end interest rate products to factor in that higher interest rate in a shorter duration of time. Hopefully that will become a little bit clearer when we have a look at the next slide, and I'll show you the ladders of each of those products. Finally, what you've got to question yourself is, this pricing that you're seeing, has it been caused by a specific event, or is it purely related to the rates? I'll show you an example of this in a few slides' time, whereby a demand for a certain type of asset actually has effectively created a pricing showing a greater interest rate cut than is actually in the market or likely to be coming. And this is because of a liquidity issue and a desire to own a certain product. Therefore, it's pushed the yields on that product lower, implying interest rates that are much lower than the central bank would like, and that is realistically indicative of what interest rates are going forward. So let's move on to the next slide, and hopefully this will become a little bit clearer. Okay, so let's explain pricing in a little bit more detail. Looking at your ladders as well, so you can go into this yourself and have a look along the curve. What we've got here is three ladders of short sterling. So what this is a futures contract on 30-day borrowing for sterling. Now, the idea is, and how the futures price shows the interest rate, is that these are all priced at a par value. So your par value is 100. By adding on the interest rate, it effectively reduces the price because you're going to have to pay that interest to buy that product. So the price effectively implies an interest rate by taking the price away from 100. So on your first example, which is June 2018, you can see that short sterling is trading 99.29 at 30. What this is implying to you is that in June next year, you'll be able to borrow pounds for 30 days at an interest rate of 0.7%. Currently, Bank of England interest rates are 0.5. So this is implying a probability that interest rates are going to rise by nearly 25 basis points by June 2018. So it will be phrased as a 25 basis point hike is 80% priced in for June 2018 because of the fact it's not fully 0.75% on that short sterling ladder. Moving forward, come 2018, we've only priced in 35 basis points, so 0.35% increase in interest rates. So not a great deal priced for 2018. We're certainly only halfway to 2 rate hikes by 2018. By June 2019, however, you can see that the market is trading at 99.01 at 02. This is showing that by June 2019, Bank of England interest rates will have risen from 0.5% currently right the way up to 1%, so 2 rate hikes by June 2019. This is around about in line with the Bank of England's 2 hikes in the next 3 years scenario. So round about right there. We're at the end of 2018, so if anything, it's slightly more aggressive pricing. So if they reiterate that it may only be 1 hike in the next 3 years, what you're going to see is a bid into those contracts, the June 2019, DEC 2018, to price out that pricing of 1 rate hike, of 2 rate hikes by June 2019. So hopefully that's cleared up pricing in the short end, and that gives you a very clear indication of interest rates, or the expectation that the market currently has of interest rates going forward. Now, going to our example of the ECB, looking at pricing and expectations for 2016, we had no pricing at all of a rate change. We saw a small possibility of a change to the asset purchase programme, which you remember from that first slide was sitting at 80 billion. And finally, there was an economic or an economist expectation of an extension to the asset purchases of 6 months. Next up, we take a slightly more qualitative view of what's happened since the last meeting. Firstly, we're going to look at changes in pertinent economic data points. Now, the reason for this is some central banks are data dependent. By this, I mean that they will state that we will not move until unemployment, for example, falls below a certain rate, or you know that a central bank's mandate is for inflation at 2%. So any movement towards 2% may mean that they're going to preemptively try and hold the economy back, so that rather than hitting 2%, we drift up to it and hold around 2%. So trying to slow down the market before it gets there. So economic data points are going to be very important, particularly if the central bank has guided you towards one or another data point. Next up, we want to be looking at market moves. You're trying to gauge the sentiment of the market. You're looking for anything anomalous. Has one market perhaps moved a long way that doesn't really match other markets? This is somewhere where, again, you can start thinking there could be a trade in this, or the central bank may have to talk about this. So that's just building up your bigger picture of what's been going on, and also perhaps attracting you towards one market or another to actually think about trading. The whole point of this is that if a certain reaction happens from the central bank, movement prior to it is going to create a greater likelihood of a more severe move on the central bank. For example, if a central bank has said, we will hike rates if we hit 2% inflation target, and they're at 1.9%, and the central bank does nothing, or they're even at 2% and the central bank does nothing, this is going to be quite a big surprise, because the market is expecting, and based on what the central bank has already said, they should be changing rates at 2%. So it's the willingness of a central bank to act contrary to data that is going to create a larger move. And again, that's something you need to be aware of. If the data's saying one thing and a central bank says no, we're doing another, that's a bigger shock to the market than the central bank going with the data, even if the economists haven't quite said that they think the central bank will. So let's move on. Let's go and have a quick look at some of the data prior to that December 2016 announcement. Okay, so let's have a look at the data. Remember, this is for the ECB for December 2016. So I've got two charts here, Eurozone CPI, Eurozone GDP on the right. I'll go to the GDP first. What you can see from this chart is from the beginning of QE from the ECB, so early 2015, we've seen a rise in GDP taking us from 1% up to 1.7. So it seems that the economy is expanding in Europe, and this is running Europe out of the recession following the European debt crisis of 2010 to 2012. In terms of inflation, and remember, this is the key thing for the ECB, their mandate is for inflation at close but below 2%. Inflation has not really picked up in quite the same way. Yes, we've got a low just prior to QE starting, down at 0.5%. And this has then picked up, and we've moved up to 0.9%. So an improvement, but clearly a long way from the ECB's target. And so certainly illustrating that, particularly for the majority of 2016, inflation's not really changed at all. So it then brings in the question of how big a deal would a change in the asset purchase program be if the ECB did it at this meeting, because of the fact that inflation hasn't really picked up that much. So you're just taking a few points from the data that's coming out. GDP, great, is looking very good. Inflation, though, is struggling a little bit. So moving on from there, we're going to have a look at markets that have actually moved and some anomalies that we're seeing. Okay, so let's move on to having a look at different markets. What I've got here for you is German bond yields. We've got a 10-year bond, a 5-year bond, and a 2-year bond. Now, the red line's indicating where they were at the previous meeting and to where they are now. As you can see, 10 years and 5 years have both risen. This is factoring in that over time we are likely to see some drawback in stimulus and potentially raising rates. 10-year is slightly more focused towards inflation too. So what this is showing is with that increase in GDP, economic expansion, we're likely to see rates at higher later on down the line. However, note the 2-year. 2-year rates have actually fallen. So what's this telling us? 10's up, 5's up, 2's are down. What's been happening, and you'll see that if you look at this chart, 2 years actually dropped to around about 0.8%, negative that is. So what you're having is a situation whereby people are willing to buy bonds that give them a yield of less than parking their money at the ECB. Now, the reason for this was the need for these bonds was to take part in repo operations. So remember those open market operations? If you want to borrow liquidity from the ECB, you need to hand over collateral. So in order to do this, banks were buying German 2-year bonds because these were sufficiently eligible collateral, high quality debt instruments, and using them for refinancing to gain additional liquidity from the ECB. So there was a hunt effectively for high quality collateral to be used. So this is now setting you up thinking, well, there could be a bit of a trade here. What could the ECB do to alleviate this issue? Now, one of the ideas, and this came up in a sources comment as well, is what they could do is the ECB could actually lend bonds out. So what that's doing is increasing the supply of bonds in the market, which would then consequently create a fall in bond prices and a rise in yields, pulling German 2 years away from this negative 0.8 rate that they're currently sitting at, and also moving them a little bit more in line with the moves higher in the 10 and 5s. So that's something that you do need to be thinking about as a potential movement here. And so could actually, rather than normal, draw your focus towards a 2-year bond. Perhaps you'll be trading the Schatz on this one, rather than what would be typically traded as in German Bunds, the 10-year, or even the Euro. Next area you want to be looking at, I know this does seem like a lot, but this is why, as I say, I'm going to give you a framework, a very simple way of condensing all this information into the very pertinent stuff you need. Next up, sources, comments. So what happens is central banks try and guide the market between meetings. They'll do this from various press conferences, so you'll get certain central bank speakers who will give their opinions on perhaps what they need to do with their monetary policy going forward, or their opinions on the economy. By saying perhaps that they feel that inflation rates are going to pick up at a faster rate, that's implying a slightly more hawkish tone. Now, what I mean by a hawkish tone is that that person speaking is of the view that inflation is likely to rise faster, therefore interest rates are likely to have to rise, or a reduction in stimulus is coming. So a hawkish stance is a more contractionary monetary policy. A dovish stance, the opposite, is a more expansionary monetary policy. So keep those two words there. We'll be using those quite a bit coming up in the future. Now, there's a few ways they do this. Generally, it's a scheduled press conference. However, we do often see sources, and this is particularly prevalent from the ECB. You will get unnamed sources, so you don't know who these people are, who have apparently spoken to a newswire. Often it's Reuters, but it could be Financial Times, it could be a German newspaper, etc. It could be various different places. What you've got to then do is take on board these source comments. Are they giving you a clue as to what's going to happen at that next meeting? Also, what you need to be considering is the trend of comments. You're not likely to get too many sources in between, and the sources, particularly from the ECB, are very pertinent and are rarely, and I will say this very clearly, rarely wrong, but they are wrong occasionally. So always take them with a pinch of salt, but be ready to act on the sources, and we'll be looking at that later on, but also keep them factored into what your expectations are going forward. Also, the next important thing is you need to be looking at the trend of comments. So how these comments have progressed. Have they got increasingly hawkish, or have they shifted from hawkish to dovish? And also, who's made these comments? A comment from the head of the central bank is going to be a lot more important than from one of the lesser members. And what you need to do is build up sort of a knowledge of these members, so you know about their character in terms of their likelihood to speak, but also how important they are within the central bank in terms of guiding policy. Are they the one who's synonymous with always being dovish. And if they say something dovish, how important is that? It's when a dove says something hawkish or a hawk says something dovish that is the most important. Next up, these comments as well. Keep them in the back of your mind, because the comments could end up becoming part of central bank language going forward. If you've picked up on this early, noting down the comments as they come out, then you're already ahead of the curve. You're ahead of everyone else in terms of thinking, oh, if this comes up from the central bank in their statement, you already know what that means. So it's all about being prepared and just thinking through these little things, keeping track of them. That way you've already seen it before it really happens. Okay, so here we go with sources. This is what we got from various ECB sources prior to that December meeting. To start with, we got a large majority of policymakers are thinking to extend QE beyond March. So that's where some of the economic expectations have come from. Also, however, there is a consideration of signalling an end to QE. So putting a final date that they're going to end QE in. So some discussion there is potentially a point that could come up at this meeting. So now you're already starting to think about duration of these bond purchases. That could be very important. Next up, ECB seeks to lend more bonds. This was a way to alleviate those problems in the repo market. The reason why we saw German 2 years with a much lower yield. So that's an attempt to solve this problem, or sources believe could be an attempt to do so. But bond lending will depend on other changes it makes to asset purchase programme, may not be finalised in December. So effectively what they're saying is the ECB can lend bonds, but also it may impact on what else they do with their asset purchases. Finally, and I'll explain the capital key a little bit more in future, but there's talk of changes to the capital key, the issuer limit and the yield floor are under consideration. So all of a sudden you've now got multiple things that could be talked about from the ECB, multiple areas of potential trade. A trade on the capital key, a trade on issuer limits, a trade on the yield floor. I'll explain these a little bit more in the setup to how this actually played out. But you've got multiple ideas of what you can be trading now. Statement science. What do I mean by this? Right, statement science is the idea of looking at the construction of central bank statements. I said earlier, central banks will often produce a very formulaic statement that uses very similar phrases, very similar structure. So it's understanding how these statements are built that allows you then to start sifting through it and look for certain areas that are changing or implying something. They will often use certain phrases and certain areas of their statement to tell you more going forward. This can often, and in the ECB's case, has often been more important than the actual policy change, as I mentioned earlier with the use of the phrase strong vigilance. There will be key taglines. You've got to be thinking about how these can be adjusted. Now this is where it is more science. The fact that you've got to then start planning forward how these things could be adjusted very specifically to imply something new coming out. Structure of the statement could change, and this is almost an element of tone. This is where we start deviating from science and more towards art. If this statement begins with a certain tone, starts in a certain way, this can start giving you a clue that perhaps we're going to see a bit of change here, and perhaps a more downbeat tone could imply continued stimulus, more upbeat, and perhaps we see a more contractionary policy going forward. What you do need to be focusing on, and this is where we get back to the science part, is the history of these statements. What is it that has preceded a move in the past? Because it's very likely that it's going to be a similar phrase or a similar structure to the statement that is going to tell you there's a move coming in the future. So we're going to have a quick look at this, how statements change or how the communication of the central bank on these meetings changes, that gives you a very good clue as to what they're doing without them necessarily explicitly saying it. And that's what gives you that little bit of edge, because not everyone's going to pick up on those key small nuances in the statement. Okay, so again, looking at the ECB in preparation for this December 2016, what we've seen is recently a new format in how information regarding policy decisions is disseminated to the market. Previously, you would get a figure release at 12:45 that would tell you the change in interest rates. That was it, just the change in rates. In March 2016, we got a new format, and this was when the ECB announced an increase in asset purchases and also a deviation into corporate bonds as well, so an expansion of QE. At this time, what we got at 12:45 was not just the change in rates, but you got a statement first up. And when you read these news feeds, the first thing starts at the top and scrolls down. So chronologically, we want to be looking from the bottom upwards. ECB took policy action at this meeting. That had not been seen before. And what happened is they then stated how their policy changed. So not quite statement, but release format science. We've now seen a new way of releasing information. You may well get a steer on asset purchases going forward at 12:45, not from the statement that would come at 1:30. Moving on, a quick look at previous statements and a look at how the statement starts if there's been a change in policy, and this is key. When there's a change in policy, you will often see a change in the structure of the statement, and that tone tells you what is likely to be, or at least that there is likely to be a change, and potentially, as you already know the expectations, it tells you what that change is going to be. Now, if you think back to earlier slides when we looked at the ECB, usually they will start their statement at the press conference with, based on our regular economic and monetary analysis, the ECB key interest rates either changed or remained at whatever level. However, when they have changed policy, this is in January 2015, March 2016, what they did was the start of the press conference was, based on our regular economic and monetary analysis, we conducted a thorough reassessment, or in the case of March, we conducted a thorough review of monetary policy stance. This change, as soon as you see that difference in the statement at the beginning, you know something's up. You know that there's likely to be a trade in here. So that's already setting you up for it, and that's what I mean by statement science and understanding the history of it and where these little things change that give you that big clue as to what's coming up next. After your statement science, and we will come back to this in much greater detail when we do the ECB section of this course. Next up, a bit of chart analysis. There's no point in having all sorts of good ideas if you don't know how you're going to execute these based on your levels on a chart. So key thing, know your levels in your key markets. Maybe a market that you're not trading, but if you see one market that's correlated with the market you are trading hit a key level and start to turn, that could be a signal that your market is about to take a similar move. So know your key levels. Most importantly, the market that you're going to trade, know your levels inside out. Be very clear on them and know exactly what you're expecting the market to do. So next up, in terms of actually thinking about markets, and this could influence which market you trade, think about which ones are showing trend. Is a move likely to be greater in one direction or another? So if a market has trended higher into an economic decision or a central bank decision, how much could that central bank do to continue that trend or create an aggressive move in that direction compared to the opposite move? If a market has drifted higher into the central bank announcement, could you then have a situation where the move to the downside is actually much more structurally going to be aggressive, so sets you up for a much more aggressive trade to the downside, compared to a move to the upside along with a trend that is already going. Next up, decide what market you want to trade. This is really key. It's so easy to think, oh, well, that's a good trade in this market, that's a good trade in this market, I could trade this, this, this and this. In the moment when you've got to assimilate all the information and make clear, distinct trade decisions, trying to jump into multiple markets can often cause you more trouble than it's worth. So what you've got to decide is, are you going to trade the most in-play market, so the one that is going to be most sensitive, or are you going to trade a market that you're more comfortable with? I use the example of, if you trade a 10 lot in the Bund, and actually there looks like there's perhaps a much greater chance that there could be a euro related trade, but you know you're not comfortable trading the euro and you're only going to trade a 2 lot, it would be a clearer thing to argue that actually you're better off to trade more size in a market you're more comfortable to trade than it would be to trade less size in a market that you feel may have a greater move. So you've got to strike that balance. Is it a market that you want to be more in play, something that you think is going to be the most sensitive, or are you going to stick with a market that you're most comfortable and most willing to actually put a bit more size on, understand the price action and manage that trade a lot better? Finally, one bit of advice when going through your chart analysis and deciding, and this is something that people don't always do, and it's very easy to get sidetracked and start seeing a market that you thought was in play start to move, and now you think, oh, I should have traded that. Think of the opportunity cost there. By jumping around, you're missing opportunities in the one market that you are generally good at. So stick to your plan. Even if something else is doing more, you know what your plan is. If you stick to it, you're more likely to be able to manage your trades better and limit the number of sloppy trades and the number of jumping from market to market, which can often end up with a situation whereby you almost lose perspective of what's actually going on. And this detracts from your overall trading and your overall process of what you're trying to do. So let's go and have a quick look at some charts and see what was going on prior to this December 2016 decision. So let's go and have a look at a couple of charts. Being as this is the ECB, I'm going to look at the Bund and the Euro. So what we've got with the Bund here, on the left I've got an hourly chart, on the right I've got a daily chart. Now focusing more on the hourly chart, the daily chart is there merely to illustrate the downwards trend in the Bund at the moment. We've clearly seen lower highs, lower lows, so this market is definitely trending down. Move it onto the hourly, and this is where you start picking up levels to trade. Looking at the downside, you've got this clear almost double bottom at 160.92, a secondary low at 160.72, and then really a lot of open space below. Only real reference point, little peak of volume down at 160.50. Beyond that, you've then got a lot of open space as this is a new contract to move into to the downside. To the upside, what we do have is a trend coming in at 162.00. You then got 162.15, little smaller areas to trade, and beyond that, the 162.15s, you've not got a great deal all the way up to 162.68, and then following on from that, the 162.68 incidentally is the little red mark that shows that little dip in volume on the right hand side of the chart, and then 163.01, the peak from the sell-off a couple of days prior to this. So they're the levels that you want to be looking out for, and a clear downtrend for the Bund. Moving on to the Euro, what you can see from the hourly chart on the left is a market that has fallen, consolidated, and is now starting to tick back up. So this market's showing a bit of strength, but is reasonably even in its positioning in terms of we have got scope to the upside, we've also got scope to fall back down into the previous range on any failure to continue to the upside. Looking at it from a daily point of view, we've seen a very solid sell-off that has then turned around quite aggressively in recent trade. So in terms of trading areas, we're currently trading around about the 110. To the upside, you've got a couple of gaps up around about 110.50 and then 110.81, which is shown by that recent low and the only line on the daily chart. So that's going to be an area where we could come back up to previous support and find resistance at it. To the downside in the euro, there's not a great deal to stop the fall until we do get back to the top of that previous range. That's around about the 109.10 to 108.94 area. So that's going to be the next area you're looking for. They're going to be your key levels. Now remember, if say for example you're trading the Bund, you see the euro rise on perhaps hawkish news and then start to turn around, that could end up being a little bit of a signal that if the Bund has fallen on the equally hawkish news, potentially you could see the Bund starting to move back. So knowing your levels in other markets gives you quite a big clue there. So on to the next slide. What we're going to have a look at is the types of trades that you can be executing on this ECB. On any central bank meeting, you have 4 distinct types of trades to be taking on. Any trade that you think up is likely to fall into one of these categories. This is going to influence how you trade it, your expectation of the move, and also the size that you're willing to put on this trade. First up, binary trades. This is the most clear cut. You have 2 possible outcomes. This would be an example of either a rates unchanged or a rate hike, particularly if there's an expectation for both. So you've got potential for an unchanged or potential for a hike. Therefore you have a very distinct trade. One's a buy, one's a sell. So this is typically on just a very clear-cut trade, but the way this trades, you're likely to get a very, very strong move early on, and it's potentially more likely that you will have to trade the aftermath of this move, as the speed of the move may well be too much. Next up, you've got a specified binary trade. So it's perhaps not quite binary, if you will. What happens here is where you have multiple outcomes, but perhaps only 2 of them will actually give you a distinct trade. So there's a possibility, say, when we talk about the Bank of England, you get a vote breakdown. Now it could be that of the multiple different breakdown scenarios you could have, 2 of them will create a trade, one a dovish, one a hawkish trade. So therefore it's a specific binary trade. You're only looking for certain outcomes to trade, not trying to judge all of them and not acting on all of them. Next up, and this is where it becomes a little bit more nuanced, and this is where your understanding comes in a little bit more. Varied outcome trade. What this is where there's not a specific outcomes you could get. You could get various different outcomes, and they could come to a varying degree of severity. For example, if you've got economic forecasts going forward, you could know whether there's going to be more or less than the expectation, but the difference between the expectation and what is given as the forecast is where the trade is. It's understanding that variance and the importance of that in terms of severity of a move. Finally, you've got your interpretation trade. This, I think, is the trade perhaps with the greatest edge, particularly if you've done your research, done your preparation, got yourself ready for it. If you're not ready, then the interpretation trade is a lot more difficult. It's mostly down to a language trade. This can be tone, this can be picking out those taglines. But whatever it is, it's all about you hear the information and you know exactly what that implies and you know exactly what to do. So that is really a culmination of your preparation there. Put that into action and there you have yourself a trade. Right, next up, it'll be a video and we'll be looking through the setup to this ECB meeting, what pertinent information was there, where you could trade and what you could trade off. So we'll go and have a watch of that video and then we'll have a look at what actually happened and how the market traded. Alright guys, that's your preparation. Now in the video, it should become a lot more clear on how you can break this all down, give yourself very clear trades, very well organised, efficient manner of looking at central banks.